It's a scary thing, and that's a very, very difficult concept for people to really understand. But hopefully it doesn't take more than one bad experience for someone to realize, okay, you know what? Shooting for the stars is maybe a recipe for disaster, and it's better to build up a good solid, singles and doubles and long-term investment thesis where, some deals will outperform projections, some deals will underperform projections, but if you stick with it over the long term, you're going to do very well.
Welcome back to Multiple Perspectives. I'm David Lofgren. One of the big questions I've been wrestling with lately is how investors can balance risk and reward without getting swept up in market hype. That's part of what led me to today's conversation. My guest is Rob Beardsley, founder of Lone Star Capital. In just a few years, Rob's built a significant multifamily portfolio in Texas, but what's just as interesting is how his approach has evolved. We'll talk about the early days of chasing value-add deals, what he's learned about managing assets through a pandemic and interest rate shocks, and why he believes that conservative underwriting isn't just nice to have, it's essential for creating healthier markets. Whether you're a passive investor looking for better questions to ask or just curious about how real estate cycles play out, this is a conversation full of practical insights. Let's get into it. Rob, welcome to Multiple Perspectives.
Thanks for having me.
So you founded Lone Star Capital in 2018, and in just 7 years, you've built a portfolio of over 5,000 multifamily units in Texas alone. Is that right?
Yes, that's correct.
There's a lot that I want to cover in this interview, including the 2 books that you've written about CRE investing, sort of both on the supply and the demand side. But first, I want to talk to you a little bit about your personal career journey, if we can. If I have my timeline right, you graduate from college in 2018. Within a year, you founded Lone Star. You're like a CEO, first year out of school. And then I can only imagine that like the 2018 version of Rob had a vision. Like there's some way that you're imagining your future is going. But, in hindsight, we all know that all of us are headed headlong into this like black swan event, this once in a generation pandemic. But in 2018, we're not there yet, right? So take me back to like pre-pandemic Rob. Tell me about starting Lone Star, what's going on in your life at this point, and sort of like what you're imagining your future will look like.
Yeah, so you got most of the timeline correct, but actually I didn't finish college. I dropped out in 2018 and I got the real estate bug freshman year of college, started doing my research and figuring things out, and kind of I started writing down in my goal book that I want to build a real estate portfolio and I want to invest in real estate and stuff. And my family has a background in real estate, but not on the investment side, only on the residential brokerage side. And so I had an adjacent, experience and exposure to real estate, but nothing from when it came to long-term investment and building wealth, cash flow, accumulating assets. Those were all, unfortunately, foreign concepts to my family. It would have been much better to come from a rich family and, have it made from the start. But still, I was, grew up middle class with definitely enough of a, great family, great direction, good parenting, and guidance towards a better vision. And so my better vision equated to, okay, I like real estate, but I'm more interested in building a long-term business out of it rather than just chasing commissions and kind of having a glorified job, if you will, and instead running a true business. So that's kind of what 2018 version of me had in mind when I had started the company while still in school, then dropped out. And basically for those first couple of years heading into the pandemic, it was first about, giving birth and then surviving. And so, giving birth basically just means like actually starting a business and having like a real company. And in our business, that is, in every business, it's so difficult to start. And for ours, I feel like, not to play the world's smallest violin, but I feel like it's very difficult because you have to have capital behind you. You have to have people that trust you from a lending perspective, from an investing perspective.
Okay, interesting. So your family is, you have a family background in real estate, but on the brokerage side. So not on the sort of capital raising, general partner, limited partner, like true commercial real estate business model. So tell me, how do you get interested in that while you're in college?
Yeah. So going back to college, I mean, there's a lot of great resources out there, kind of like the resource that we're putting together right now, right? Podcasts, ebooks, and online forums, and in-person meetups and conferences. So really running the gamut from free to paid to in-person online. And so I just started consuming all those things, and I didn't know what GP and LP was and things like that. I just knew that I myself wanted to invest and build a portfolio. And it kind of clicked for me because I thought, wow, what a perfect synergy if I can actually start a business that does this, that I myself would like to be a customer and benefit from as well. It's like, I need to kind of do this anyway. And so I might as well run it as a business as well. So that was kind of my nascent thought as I was getting off the ground.
Interesting. And so tell me about those, the first year or so of putting this business together. It's my understanding that primarily you guys are investing in Texas, Lone Star Capital, right? But you go to school at Carnegie Mellon. You're currently in New York. What is the sort of drive to look at a different market, a different geography, go to a place that isn't just sort of in your neighborhood, so to speak?
When we got started, the hotspots were fairly similar to the hotspots of today, albeit we've had quite a lot of kind of market changes with the pandemic and then the interest rate regime and an oversupply and markets going up and down. But by and large, the hottest markets in the country remain really in the Sun Belt, going from Phoenix, Arizona, to the key markets in Texas, to the Carolinas, to the key markets in Florida. When we got started, we wanted to be where the action was. We wanted to be where we felt like we could be successful, scale, and also where we would have an easier time raising capital. And I feel like that's kind of, you pick your poison in this business, because you can go somewhere where you can invest where the themes are very clear, the trends are there, the interest is there from investors. And so you're not going to be selling as hard on the story because people are already bought into, let's say, for example, the population growth, the migration trends, the job growth, the landlord friendliness of Texas. Investors are bought into all that. And so you're going to have an easier time raising capital for that theme or strategy. But of course, when you're picking that, you're also making your life more difficult when it comes to being a buyer, because with all this interest, there's competition. So not to get too in the weeds about, competition, supply and demand in these various markets, but I just want to kind of make it clear that there's no easy way to win here. You can't just say, well, I'm just going to go invest in Phoenix because rent growth is 20% year over year. Well, that was true until rates went up and it was the most overbuilt market in the country, not trying to poo-poo Phoenix, but just using it as an example. And then in 23, 24, for those couple years now, rent growth has been negative and has been in the opposite direction. So investing is very hard and it's not easy. So you can't just pick a market and say, this is the best market and life's going to be easy. But with all that being said, we felt compelled to pick a good market that we felt like would have legs for a long time. We didn't want to be tourists and be in and out of different markets. So we felt there were long-term trends to be had in Texas, and similarly, a place that we could scale and become experts in. And that's kind of the thing I preach to people these days. Whoever asks me about what markets are good for them, I say, it's more important that you pick a market than the actual market that you pick, because you can really be successful in any market. And also, just to go back to my point about kind of making your life easier or harder or picking your poison, if you pick a market that is perhaps out of favor or doesn't have a lot of demand from investors, it's going to be very difficult to raise capital. If you're trying to raise capital for a story or a theme that is just out of favor, it's very, very tough. Investors don't, more so than not wanting to lose money, investors hate looking stupid. So an investor hates to be the only person who made this kind of investment and then they lost money, because then they look like an idiot. But if an investor puts their money into a deal that everyone thought was a sure thing and it didn't go their way, oh, well, the market, oh, well, everyone was in the same boat.
Lost together, yeah.
Yeah. So good luck raising money for things that are out of favor. But on the benefit, you are going to be in more of like an undervalued or overlooked market or strategy, and you can actually perhaps have an easier path to operational success. So I digress.
Yeah. No, this makes sense. So talk to me about, in those early, those first couple sort of pre-pandemic years, What is the buy box that you're starting to sketch out? What is the sort of business model that you're looking at in Texas as you're trying to figure out, like, how are we going to specialize, develop our area of expertise, and understand, like, what is potentially a repeatable business strategy?
Yeah, so getting started in 2017 and actually acquiring our first deal in 2018, the flavor of the day was value add. And in many ways, that flavor of the day persists to this day, which I actually have some issues with because I think, and especially now that I know a lot more today, I think the world is a lot more nuanced than that. But basically, when getting started, like myself in 2017, everyone wants to do a value add deal. And what that means is they want to buy something and they want to improve it because they want to force appreciation and create value. And it all makes sense, but it's, again, nothing's ever so easy and it's not so simple. But at the time, that was absolutely working. And it wasn't necessarily working because it was a good strategy. It was working because the capital markets were moving in that direction. Rents were growing because of market forces, supply and demand, population growth, those things. And then at the same time, you had cap rate compression because there was more capital inflows into multifamily investing. And the beauty of this time going into the pandemic and through the pandemic was really a lack of discernment from capital when it came to asset quality. And so in a way, almost the more risk you took and the worse assets that you purchased, the better you did, because everything inflated up, everything went up in value. And so almost if you bought like the lower end property, it would also go up in value, which was kind of a market distortion. So at the time we thought, oh, we were super smart. Let's buy Class C property, which is run down. It's in a tougher area, but we'll roll up our sleeves and we'll manage it and we'll value add it. We'll renovate it and raise rents and do all these sorts of things. And it's great. And also, you've got people going on stages at conferences saying, yeah, in Class C, much to contrary belief, actually is safer than Class A because in a recession, people move down and, they want the more affordable apartments, not the nice Class A. And so this is kind of a lot of what syndicators and newbies believed. Thinking about it today is ridiculous because, in reality, we've felt it, we've lived it now. And going through more difficult economic times, you see how everything goes from Class A and down, where Class A renters are renters by choice. They have more income, they have more disposable income, they have more savings, and therefore you're much more likely to collect that rent. Whereas you go to the bottom of the spectrum, when you go into really difficult workforce housing, you've got non-paying tenants, you have crime, you have a lot of deferred maintenance. It's a slog. So this is a long way of answering kind of, when we got started, we romanticized this strategy and we thought, this is amazing. We're going to buy fixers, right? And everyone can wrap their minds around this because you look on the TV and you've got like flippers and all sorts of like residential real estate, investors and fix and flippers and things like that. And that's what you think about value add. But the reality is this game is a whole lot harder than it looks. And managing workforce housing is a difficult task. And so we've earned our stripes. We've learned it. We've been through it. But I'm happy to say today that no more for me, please. I want to buy the easiest deals to manage. I want to buy the safest deals in the best areas that we can. And so our thesis has certainly evolved since our inception.
Interesting. Okay, so it sounds like you learned some lessons early on, and I can totally see how you're in that place where you're going, okay, well, I could probably do the fix and flip thing, but I'll do it like 100 units at a time instead, right? Like it's a very easy and romantic narrative to jump into. So you're learning all of these lessons into and through the pandemic. Like it sounds nice to just think, okay, I'll switch to Class A. I'll move to something where it's like all of the tenants are super amenable and the issues aren't that big, but finding alpha, like the real ability to realize upside is in identifying. Still, no matter what the property type is or whatever the business plan is, it's still about identifying inefficiencies in markets, right? So talk to me about how, even in shifting this business plan, you're able to find a place where you feel like you're still really finding value both for yourself and for your investors.
Yeah, I think that's a great point. Because the value in value add is self-evident, right? It's even in the name. Yeah. So it's very easy for people to wrap their heads around because you can look at a pretty before and after picture of a kitchen renovation and you can very straightforward to see, okay, well, the rents are $1,200. Well, if we renovate them, the apartments to this scope, we could charge 1,400, and here are the comps to support it. And so it's very clear to build that upside. And to your point, in Class A or in other things, it is less clear. And so that is the problem that we face when we talk about Class or Class B, or at least not like these very straightforward value adds, because a lot of our investors and people in the business are like, well, I just don't get it. Where's the value add here? Or this isn't enough of a value add. And there's two really big things that I stress about this topic. Number one is, just because a deal is a value add from a business plan perspective doesn't make it a good deal. And the reason for that is simply because what you pay for the deal matters the most. So it really doesn't matter how much you can raise the rents. It matters how much you paid in order for the opportunity to raise those rents. So everything at the end of the day circles back to a return on investment calculation. And I promise you we wouldn't do one of those on the podcast and nerd out completely. But it really is a fundamental thing, as trite as it sounds, because you buy in at a cap rate. Most people in the business know cap rate, but then it almost like the value add plan gives people license to not even bother as to what their going in cap rate is. It's like, well, we're buying a kind of a low cap rate, but don't worry, the value add's going to fix everything. We're going to raise rents and everything's going to be great. But I'm here to say, no, that's not how it works. You really need to actually look and see, okay, yes, we're buying a certain cap rate, but then when we do our renovations and we raise our rents, you got to factor in the time and the risk and the cost and see where you truly end up, because where you end up may be somewhat similar to where you would have if you bought just like a stable deal from the beginning and you didn't go through the headache and the risk of the value add plan to begin with. So that's kind of my issue number one, but that usually falls on deaf ears and that doesn't really work. So instead, to your point, when we're not doing these obvious value adds, if you will, we got to find ways to create value in other ways. And so some of those ways are focusing on enhancing other income through adding a bulk Wi-Fi package. So the property purchases Wi-Fi in bulk and then resells it to tenants, making a small spread. Of course, there's a lot to do about managing expenses. And because we're vertically integrated, we've been through the trenches. We've managed ugly property, nice property, and everything in between. We have the in-house capabilities to do things for cheaper on the construction side of things, and so on and so forth. So it's really, when you start thinking about investing as owning property rather than flipping it, all of a sudden the management becomes much more important, because we look at owning a property for 5+ years rather than up to 5 years.
Sure. And so, as you say, you guys are vertically integrated, meaning that I imagine you've got property management under the roof. Is that correct?
Yes.
And so then you're able to also achieve some efficiencies of scale. That if you're doing some light value add, you have contractors that you've worked with, you understand exactly how these things are going to work. That totally makes sense. So if the new business plan is sort of buy and hold and realize some of these gains through asset management functionally, you mentioned Wi-Fi as a sort of buying Wi-Fi packages. Are there other places right now that you're realizing some gains that might surprise people? Are there sort of like other asset management approaches that you're using that are like, okay, this is actually like has some real potential upside here, surprisingly?
Well, let's think about that. I think what I would say that is surprising is when you really get in there and look at every expense line item and you just start to see the fluff. And that's the scary thing about ownership of real estate, is because this is a business, and you buy a $50 million property, that's a big business, and it generates, let's say, $5 million of revenue, and the whole world is out to get your revenue. There's vendors every day coming to you saying, hey, well, if you sign up for our subscription, you can do this and we'll do that for you. And they're trying to make money off of your revenue stream. At the end of the day, you hold the cards because you've got the residents paying rent. You've got $5 million of revenue coming in every year at this business. And unfortunately, every day you've got people coming to your door. Like, for example, you have a termite inspector show up to your property and they look all serious and professional, and they tell the property manager, I need to do a termite inspection and we need to do this and we need to do that, and it's going to cost you this. And then based on my inspection results, we're going to have to spend all this money for termites. And, I'm here to tell you, no, you probably don't need to do that.
There might not be any termites.
Yeah, exactly. So, I mean, obviously your mileage may vary, but for our properties, that's, we've got that under control. We don't have that issue, and we know how to handle that issue if it comes up. So unfortunately, you have to really be kind of on guard and train your on-site staff at all of your properties to be on guard for various things. I think the number one thing is basically having an ownership mindset permeate all throughout the company, down to the on-site staff, the property manager, the leasing agent, the maintenance staff, because the cost difference between doing things in-house versus outsourcing them is mind-blowing. And, the good news is the status quo in property management is to outsource things. If you have a plumbing issue, you call a plumbing company, and the plumbing companies, they charge you money just to show up. So they've already billed you and they haven't even done any work yet. And then they look around and they say, oh, nope, that's going to be a lot of work. That's going to be expensive. That's going to be time consuming. That part's on back order. And so it really pays so much to have great people on site who have an ownership mindset and say, no way, we're not calling a vendor. We're going to fix it ourselves. And those people, like any great people, are hard to find and they're expensive. People want to get paid more. So I think the big thing I will just say is kind of like a mentality shift of, we want to perhaps go over budget on payroll to have the best people. But in turn, we're going to save a lot of money and in many places when it comes to doing things in-house. For example, our in-house construction team is in the process of completing a roof repair and replacement project at one of our properties that was damaged in hurricane and in Houston. And so we had multiple quotes from multiple roofing companies, worked with insurance to get an insurance claim done. And in the end, the best quote we got from roofers was $700,000 for these various replacements and repairs. And we're going to get it done in-house with our in-house construction crew and our director of construction and everything for $250,000. So those sorts of things start to add up.
Less than 50% of the cost.
Yeah.
Of the bid. That's incredible. Okay. So, I feel like there's a ton that we could talk about as far as management and sort of like being in the position of like sponsoring these deals and truly sort of being at the helm. But I think for the vast majority of our listeners, they're more interested in what it means to become a limited partner in a venture like this. And you happen to be a great person to talk to about that. You have written a book that has gotten rave reviews online, The Definitive Guide to Underwriting Multifamily Acquisitions. I wonder if you can just sort of talk about what drove you to write this book. What were the kinds of conversations you were having with people that made you think, I need to be able to point them towards a resource where, they can actually start to understand the details of underwriting and analyzing these offerings?
That book was really started a little bit prior to COVID, and then during the initial lockdown period, then I kind of just found myself at home a lot. And so then I just really sat down and said, I'm going to crank this out, finish it up. And I wrote the book really quickly. And the book came together so quickly in part because it was such a straightforward writing process, because all I did was pull out our underwriting model that we use to evaluate properties. And I just went step by step through all the inputs and on the assumptions and kind of the rationale for everything. And I just kind of wrote it all out. And so firstly, that's a resource that I wish was available when I had gotten started, because it's, in my opinion, so straightforward. You either have kind of textbooks that you would perhaps see in a college classroom, and those are kind of useless, or you would be pitched to attend a $3,000 weekend event at a boot camp where someone teaches you how to underwrite or something like that, which probably would be great, probably would be helpful, but I wanted to kind of put something that's in between, right? Maybe like a $13 book.
Yeah, I was going to say, needless to say, the book is significantly less than $3,000.
Yeah. So that was kind of my thought selfishly, to write to my former self. But then also, kind of to your point, there was a thought in my head as well of, passive investors, LPs, are investing into the deals a lot of money. And a lot of times they're not looking at the underwriting. Not to say I think they should become experts and underwrite all these deals and take all their time, because the whole point of being a passive investor is to be passive. So it is a bit of a paradox and a fine line, but I just wanted to create a resource that if someone wanted to approach it, they had the confidence, the skill set to do so, because I was observing other people in the business basically kind of eschewing away passive investors from even looking at their underwriting. Say, well, you don't want to look at that. That's not for you. It's complex, and oh, it's proprietary. Actually, we can't share it and stuff like that. And I just thought that was baloney because there's
But
nothing
we're confident we're
proprietary.
going to achieve a 35% return.
First of all, there's nothing proprietary about underwriting. We're talking about the simplest business in the world. We're collecting rents. We have expenses. It's pluses and minuses and percentages. So simple spreadsheet. So I created a spreadsheet when I first started, and I decided, you know what, instead of selling it or trying to do something crazy with it, I'm just going to put it on our website, give it away for free. It's been downloaded over 20,000 times. And I'm very pleased with that decision because I wanted to kind of, like I said, similar to the book, put that information out there so that if someone wants to, they can actually develop the skills and the confidence to wade into this, uncertain territory where, yes, you can actually evaluate the deal and not just believe the numbers at face value.
Right. Interesting. So do you feel like there are any sort of secrets here that people need to uncover? Or is it really just sort of when you're looking at a potential investment, take this framework, this basic underwriting framework, and just go step by step and sort of question what the assumptions are?
I think, yeah, it's unfortunately, as unsexy as it sounds, you have to go step by step, because if I just say, you know what, you really just need to watch out for the exit cap rate. Well, that's good, but that's just one thing. Yes, that's a very important input, but it's only one input. And if everything else is manipulated and that one looks okay, then, it doesn't save you. So you kind of need to look at everything holistically, because or if I were to look at someone else's evaluation of a deal or an underwriting, I would look at it holistically, and I wouldn't necessarily get all turned off if I think their exit cap rate is aggressive. I wouldn't say, oh, this person is lacks integrity and they are not to be trusted, because I will look at the whole thing. Because if they're very conservative on other places, but then a little bit more aggressive here, I'd say, okay, I get the full picture. So that's why it's so difficult to just tell someone how to quickly back of napkin, because, back of napkin almost doesn't work. What I would say
napkin's not big enough, right?
It really isn't. What I would say instead is for people to focus kind of in a similar vein, but if it's not on the numbers, it's on the whole picture. I want to know, tell me about the area, tell me about the property condition, the performance, the business plan, and just really understand the full scope of things. And it sounds easier than it is because you can't compare those details in a vacuum, right? So you kind of have to have a basis to compare it against. For example, if I say, well, the median household income in a 1 mile radius is 90,000. You say, okay, well, is that good? Is that bad? It really kind of depends. So you need to dig in a little bit more and kind of get some context and know the area that the property is in, because we're investing in real estate at the end of the day. So it's all about location.
Sure. Yeah. Underwriting, and specifically this sort of like mathematical modeling, if we want to call it that. I know that sounds more intimidating than a lot of times, as you say, these are really just sort of basic arithmetic. But that can still, that's only one facet of what some investors may want to think about when they're going into a deal. In some cases, folks are thinking about putting really significant chunks of money with a partner, with a general partner. What are the things that you suggest investors think about, the questions that you suggest they ask beyond just the sort of math of the business model? What are the things that you think investors should try and consider before they decide to write the check?
Yeah, I think getting to know the management operation. So whether it's in-house or if it's a third party, understanding what the dynamic is in the relationship. I know, as an example, there's quite a few investors out there that won't invest with a sponsor unless they're vertically integrated. I think that is a step in the right direction. I think that's probably not a bad heuristic, but I don't think it's a cure-all, because, I'll tell you, we've been a vertically integrated manager and we've done a bad job, so there's no guarantee that just because you're vertically integrated that you're all of a sudden an amazing manager. It just means that you're in control of your destiny, but there's, risk and reward to that as well. So I would kind of first want to understand that. And if it is a third party, I would want to really see their assumptions and understand, okay, well, If they think they're gonna, or you think you're gonna manage the property to these certain benchmarks, okay, that's great. Does the management company agree? If they're a management company, they probably have properties that they manage in the area, because a management company would be insane to take on a management assignment if they don't already have scale, because the property management business is the worst business ever. And it really only pays if you have a lot of scale in geographic clusters. So basically you say, okay, well, do they have the expense comps and other performance comps in their portfolio nearby to kind of prove out the assumptions? And if say, oh, well, no, they don't manage property nearby, I'd say, ooh, that's pretty scary, because this management company is pretty desperate for this fee income, because knowing from us managing, you don't want to really manage unless you have scale. And I wouldn't want to manage anyone else's property. I have enough problems. Why would I want to manage someone else's problems? So I think the whole, not to go on a digression, but the whole third-party management business, I think, is just insanity. You have to be like Greystar and manage 1 million units to make sense of it.
I want to be cognizant of the time here. I think we have maybe time for one or two more questions. I'm curious, as you look into the future, where you think, at the beginning of our conversation, you were saying that value add was the place where a lot of people were turning, specifically value add in the Sunbelt states. It sounds like through the last very sort of rocky few years, you guys have adjusted your business model. You're doing what smart business people do, and you're sort of shifting focus and shifting business plan as things evolve. We're in a pretty strange place right now. People are trying to figure out whether they can truly call the bottom of the market, or if, with all of the sort of economic uncertainty still in our midst, if we need to be really cautious about how we move forward. I'm wondering, what you think, what your take is on the next, say, year or two of commercial real estate investing, and what you think the smart play is.
Yeah, well, I love this topic. And going back to what I had mentioned before, kind of in this rising market, starting from when I got into the business in 2017 to when the market essentially topped and went down in 2022, in that rising market, like I mentioned before, there was a lack of pricing dispersion or discernment across asset quality, right? Everything was expensive, everything was appreciating, and you could buy a Class A deal for a 3.5 cap, and you could buy a Class C deal for a 3.5 cap. There was not much of a difference. Now that we've had a down market for a few years, the reverse has really taken place, which I think this is pretty natural for the market cycle. So now in a down market, now all of a sudden quality becomes the foremost thing in people's minds. And so now that pricing dispersion is back to where good quality assets have done very well performance-wise, and from a valuation standpoint, they've held up their value better. So maybe the best quality real estate has gone down 20% and the worst quality has gone down 50%. And that's where we now have this tale of two commercial real estate cities. And I think the bottom for the higher quality tier, which I will call B plus and better, that bottom occurred late 23, early 24. So that bottom is past. I mean, the lack of bidding competition and the prices back then are not compared to what it is now. That now there's a lot more competition. Prices are higher for those desirable assets, and confidence is there. People are bidding based on the assumption of rent growth around the corner and so on. So I'm very confident that that bottom is behind us when it comes to the B plus and better. Now, for everything else, the 70s vintage assets and the bad located assets, crime areas and difficult things like that, that's where it's less certain. And it's just been kind of bumbling along and languishing. Who knows, maybe at the bottom, maybe there's more to come, more pain to come. So that is harder to really see because there's less price discovery in that space, because there's less transactions. The most liquid part of the market is the highest quality part of the market. That's where all the capital went to. And, there's just not very many 1970s deals trading today. So I actually think, despite my maligning value add and say, oh, value add, it's overplayed. And I could go on and on about how I think value add is overhyped. However, with all that being said, I think whether it's right around the corner or maybe, in a couple years from now, I think value add, or essentially buying these completely undesirable properties, could be very, very profitable. It could be a very great strategy. I think it's still in some cases too early, but if prices continue to go down and if fundamentals improve and the capital markets improve where you can get good financing for these deals, I think you could potentially buy, 1970s deal that, yeah, it's old. Yeah, it's not in the best part of town, but if it's, fundamentally decent and you can get it for a song, you might be able to turn that around and do really well in those deals, just like how people were back in 2014, 15, 16, 17, buying the same thing, right? It's the cycle restarting again.
Interesting. All right. Well, we heard it here first. Can't wait to see how that unfolds. Rob, I was reading through your book, and at the very end of the introduction, you have like this little sort of just a paragraph about a motivation for writing it that I want to read to you and then ask you to explain. One of my motivations for writing this book is a small hope that I could convince investors to underwrite just a little more realistically, read conservatively, which would reduce the number of deals getting bid up based on rosy assumptions. If we could together as investors choose to underwrite with slightly different mechanics and assumptions, we could potentially create a healthier market for everyone with higher returns and safer risk-return trade-offs. Perhaps it's unlikely, but wouldn't that be something? I love that. I wonder if you could sort of explain what was going on in your head when you were writing that.
Well, yeah, definitely my frustrations of being constantly outbid was leaking through that paragraph. So, basically the idea is, typically speaking, when you're talking about an auction process and you've got a call for offers, so property goes onto the market, you have a call for offers, people put in their bids, they tour the property, then there's a best and final. And basically the best and final is, the best top 5 bids or something get invited for another round of bidding to where you're invited to counter yourself and increase the price and get on a call with the seller and then pitch yourself as to why you should be the buyer and then get one more opportunity, hopefully at least, to counter yourself again and raise your price again. And so it is difficult because essentially the person who gets awarded the deal is the person crazy enough to pay the highest price. And if we could all be a little less crazy, maybe we would be able to buy deals at a better price. But I mean, that's obviously very unrealistic, but that's kind of where those sentiments are coming from. So, I mean, that sentiment there is tongue in cheek because that's never going to happen. But what is possibly more pernicious, because it is actually happening and potentially solvable, is the way that the desire to chase high returns pushes the less sophisticated investor into more risky deals that are fundamentally just undesirable. And that might be because for various reasons, right? It pushes you into doing deals, buying an area that, you're going to regret owning in later, or using an amount of debt or a style of debt that you're going to regret later. But on the spreadsheet, it made the deal look more enticing. And so it always kind of rips me apart when someone looks at one of our, let's say, version 2.0 deals where we're using half as much leverage and we're buying in twice as good of a location. And someone says, the return just doesn't look appealing to me for this one. And it's like, ouch, like that's not good. But it's also not good because that same person's probably going to go down the street and invest their hard-earned money in a deal where the returns are appealing because they're projecting 20% returns or whatever it is. But it's on worse fundamentals, it's on higher leverage, and it's just a recipe for, disappointment.
Yeah. It's interesting. The return or the projected return is something that we can print on paper. It's so much harder to print in a simple number what the associated risk is with that projected return, right? Maybe we should be reading into it is the higher that number is, there's a reason for that high number. It's because you're taking a higher risk rather than like, well, this might be really solid returns, really, much higher potential for actually meeting these expectations.
It's a scary thing, and that's a very, very difficult concept for people to really understand. But hopefully it doesn't take more than one bad experience for someone to realize, okay, you know what? shooting for the stars is maybe a recipe for disaster, and it's better to build up a good solid, singles and doubles and long-term investment thesis where, some deals will outperform projections, some deals will underperform projections, but if you stick with it over the long term, you're going to do very well. Not to mention all the amazing tax benefits associated with private real estate investment.
That's right. Yeah, hopefully people can avoid those pitfalls, not make the mistake the first time. And it's my understanding they might be able to do that just by reading your book. Thanks so much for being on the show. Really appreciate it.
Yep. Thanks for having me. It was a good time.
All right. That's my conversation with Rob Beardsley. I really appreciate how candid he was about, both the lessons learned early on and the sort of shift in his business model as the market has changed. If you want to dig deeper, you can find his book, The Definitive Guide to Underwriting Multifamily Acquisitions, and his free underwriting model on the Lone Star Capital website, which we will have links to in the show notes. Thanks for listening to Multiple Perspectives. If you enjoyed this episode, it'd mean a lot if you subscribed, left a review, or shared it with someone who might get value from it. And of course, you can find past episodes wherever you get your podcasts. Until next time, I'm David Lofgren. Thanks for joining me.